Happy Friday. Mortgage rates are down yet again, opening this morning at 6.45% on a well-priced 30-year fix. This is in response to a huge miss in the jobs report published this morning, showing just 22,000 new jobs created versus the 75,000 that was expected. All of a sudden, the Fed is left with no choice but to act. Now, what does this all mean for individuals like ourselves in real estate and mortgage? This week, let's break it down. As I mentioned, jobs report this morning showing just 22,000 new jobs created versus the 75,000 expected in August. And this is again on the hinges of last month's huge miss coupled with revisions from months before. Next, unemployment. Unemployment last month was 4.2%. This morning, market was expecting 4.3. Yes, that came in right at expectations, but fundamentally, unemployment is moving higher. And to that, the market's reaction, we are seeing bonds, which dictate mortgage rates, rallying this morning, which is great for our buyers and sellers. And on top of that, the 10-year is broken below a meaningful level of resistance, coming down to right now this morning, 4.12%. This all lines up with JOLTS, job opening and labor turnovers, ADP's report that was published earlier this week, as well as ISM data, again, showing that there is clear cracking underneath the surface of the labor market. What does this mean, though, for the Fed? As we know, at the Jackson Hole Symposium, Jerome Powell said, yes, inflation is important. However, there is a large focus now shifted to the labor market. And as we saw in last month's jobs report and now this morning, the Fed is on high alert. So September 17th, it is absolutely expected that the Fed will cut. Now the question becomes by how much, and what does that ultimately mean for our buyers and sellers? So here, the big takeaway is rates are at the best levels we've seen in well over a year. As we saw in the last round of Fed cutting, interest rates moved higher. Now, there is a lot of data still to unfold. Next week, we'll get CPI, what implications tariffs are having in inflation, and ultimately that will dictate, hey, where rates go from here. But that being said, this is our window of time to take action. Rates are, again, some of the best levels we've seen in over a year. Do not be that individual that waits it out only to see rates go higher. As always, if you're running into challenges with communicating this message, need help in putting together scenarios, whatever it may be, myself and my team are around all weekend, and we'd always love the opportunity to support you. If you find this information valuable, please like, subscribe, share it with someone that you believe will get benefit from it as well. But as always, let's make it a fantastic Friday and an even greater weekend. Thank you.